Jesse, if this podcast has taught me anything, it's that finance is absolutely a foreign language.
But if this podcast has taught me anything besides how the stock market works and what we cover, it makes a huge difference if you have the right teacher. You need to learn in a specific order to put the stock market puzzle together, as we like to say.
Oh, yeah, I completely agree. Knowledge is compounding, like your money should be. And like when you learn a foreign language, you do start with nouns, you give them adjectives, then you assign them action, and eventually you're speaking in full sentences. We do that here.
Yeah, like stock is the noun, growth stock for the adjective. I purchased a growth stock to add alpha to my portfolio. Yeah, it is like a language.
Yeah, see? That's like speaking a sentence and fluently. And we broke down the first part of that sentence in part 1 when we did Demystifying Investment Jargon. We need to break down the second half of that sentence now.
Yeah, let's do it. We're back with part 2 of our investing terminology crash course because we couldn't leave you hanging at dividend.
That's true. That is where we left off, where the how stocks make you money. Now we got to go into the details. We should definitely do a recap of part 1, though. So don't worry if you didn't listen to it. We will make sure that you're not lost. But we still have more puzzle pieces to lay down so the picture of the market starts to come into focus.
This actually works out because we did just do a replay of part 1 like a few weeks ago of the jargon breakdown. And we gave you a whole episode on dividend investing recently, episode 95, where we left off in part 1. So just like last time, every term we cover today builds upon the previous. And remember, every term is in the name. They're functional terms. So if you're a self-directed investor like us, you've either already seen these or you definitely will.
Oh, yes. It's like it was masterly planned. Let's get fin-fluent.
You're listening to MakeHer, the self-directed investing education podcast that breaks down how the stock market works in an easy-to-understand way that actually makes sense from her perspective.
That's us. We're her. And FYI, that just means it's from our perspective. All inclusive. All are welcome. Our stats even say that we're 60% women and 40% not. So you do the math there. This podcast is teacher-learner style, and I'm Jessica Inskip. I act as the teacher. I worked in the self-directed investing space for over 15 years and talk markets on CNBC, Fox Business, Yahoo Finance, the Schwab Network, Bloomberg, Cheddar. The list is getting too long to say in my intro, to be honest.
Yeah, you're doing it. You're all over the place, and I love it. I'm Jessie Desnuit. My job is to make sure that everything actually makes sense, which means I'm not afraid to ask the questions that we're all thinking.
And we thank you for it. She helps break down the jargon and the foreign language, if you will. Together, we're on a mission to make you fin-fluent, not fin-fluenced.
All right, Jess, I know we are demystifying additional stock market terms today. Anything else on the agenda?
I mean, it's straightforward today. That covers it, mostly. Let's do the most quick review of all time of the first 20 terms. I'm going to see how fast we can do it. I'm talking rapid fire.
Okay.
No time for questions. And then continue on our journey of compounding our knowledge.
Yeah, no time for questions. That's a comment from me. Because if you have any questions, listen to part 1.
There we go.
Okay. Rapid fire.
Here we go.
Capital. Anything of value you own. Cash, assets, investments.
Stock, a tiny piece of ownership of a company.
Security. A tradable financial asset like stocks, bonds, or mutual funds, etc.
IPO, acronym, stands for Initial Public Offering. This is the first time a company offers its stock to the public, and they do this to raise capital.
Stock exchange, where stocks are listed to be bought and sold, like the NYSE, the NASDAQ, etc.
I love the way that our voices are doing this. This is fun. Stock market, the secondary market, where existing shares are traded. They trade secondhand. I don't know why I wanted to do that. All right, keep going.
Market cap, the total value of a company's outstanding shares, or the market assigned value.
An index or indice is just a playlist of stocks, a list of selected stocks used to track performance, like the S&P 500. It's how we measure it.
Sound like you said playlist, which I like. A playlist.
Yeah. It is.
With criteria. Bond. A bond is a loan you give to a company or government in exchange for interest.
Treasury is a type of bond issued by the U.S. government, specifically the Treasury.
Mutual fund. A mutually funded investment vehicle managed by a professional.
In the name, I hope everyone's getting that trend. Money market fund, a low risk. It's a type of mutual fund that invests in cash equivalent assets.
Target date fund. A retirement-focused fund that adjusts risk over time to the target date that you chose.
ETF, another acronym, stands for Exchange Traded Fund, which means it trades on the exchange like a stock, and it's like a mutual fund. It's like the evolved version, and it's a basket of investments.
Investing. Putting money into assets at the expectation of growth. You are invested in these companies.
Capital appreciation. When an investment grows in value, your capital goes up, appreciates.
I appreciate it when that happens. Capital gain, the profit from selling an asset for more than you paid. So that excess money you made off of it.
Yes, you locked in that gain. And then finally, dividend, a portion of a company's earnings paid to shareholders in the form of a dividend.
Okay, so continuing, that was number 19, where we left off. So we're starting with number 20, which is earnings per share or EPS.
Yes. So everything is in the name, acronym, EPS, earnings per share. It tells you how much of a company's profit is attributed to each share of stock. So literally, if I go on my brokerage firm's website, you're to pull a stock quote, you'll see EPS, which means for every one share that you own of the stock, this is how much earnings they've received per share. That's it.
If I'm holding 10 shares, EPS helps me understand how much of the pie is mine.
Yeah, exactly. It's more earnings means potentially more value. We want to see an increase of earnings per share. That means over time, the earnings have increased. Therefore, you could perhaps expect that trend to continue. But EPS just means it's a portion of a company. Companies make earnings. If you were to take all those earnings and put it together, that's the total earnings of the company. But since this company has stock, it's a bunch of tiny little pieces. If you were to put all those tiny little pieces together, that's the earnings per share. That's profit margin. This tells you what percentage of revenue a company keeps as profit. It's like their emergency fund. It's not the same at all, but meaning it's their cushion. And you want a big cushion, especially depending on where we are in the business cycle. But for example, if a company earns $100, their expenses are $80, so they keep $20. That means it's a profit margin of 20%. So if their expenses, that $80 goes up, they've got some cushion. If they don't make as much sales, they still have some cushion, a 20% cushion. We want a big cushion. We want it to expand as well.
Yeah, it's like how good are they at keeping their money after expenses, basically.
Yeah, absolutely. And I say in finance media all the time, this will expand profit margins. That's what we mean. Either it's going to cut cost or increase sales. Also, when you hear we're in earnings season, you beat at the top and the bottom. The top is your sales. The bottom is your expenses.
Oh, I actually didn't know that one.
Yeah.
How about volume?
Volume is pretty simple. Volume, in math, the volume of something, like how much liquid's in a bottle. I don't know why that comes to my brain, but that's what's happening.
You said this in part 1 too, now that I'm remembering. Yeah.
Oh, funny. But yeah, it's how many number of shares are traded. So the volume of a stock, it could be, usually it's in the millions. That's how many, and we look at it per day. You could even look at average 90-day volume, average 30-day volume, things like that. But that just means a volume of one means one trade. So if you see volume of 3 million or 30 million, that's how many trades happened. And you can look at that with time frames. But normally if you pull up a stock quote, you see volume, that's for the day.
Oh, for the day. Yeah, that makes sense. And a high volume means a stock is just super active, like being traded a bunch.
Yeah, exactly. And you want to see that. We'll call it a liquid stock. Like the volume in the container, it has a lot of liquidity. That's what that means. It means you can buy and sell it easily because a lot of people are buying and selling it easily. If it's illiquid, not a lot of people are. It lacks liquidity. That's where those terms come from, is volume.
Does volume just apply to stocks?
Anything that can be traded has volume.
Not mutual funds, right?
That they do not trade like a stock.
Right.
They only trade once a day.
Yeah.
So we would look at something very differently.
Okay. That's what I thought.
Yeah.
Volatility.
All right. Volatility is probably the most misunderstood word in all of finance. Volatility just means uncertainty. It's utilized a lot with the fear index, but for volatility, we're talking about how much a stock's price moves up or down. There's uncertainty. If there's a lot of uncertainty because of tariffs, inflation, whatever it is, there's higher volatility because you don't know what the company should be worth. And if there's a lot of activity, like a bunch of tweets or something like that, that also increases volatility because you don't know what that company's worth. That's what a stock price is. It's saying that's how much this company's worth. So increased volatility means increased price swings, and it goes hand in hand with uncertainty.
I feel like the market's been very volatile this year.
Correct.
Been a lot of uncertainty, probably since like Q4 of last year, honestly. So if my portfolio is basically just giving me whiplash, that's volatility.
That's correct. Yes, it's risk. You're on the roller coaster, higher volatility, more intense roller coaster, I suppose.
Yeah. And remember, don't pull all of your stuff out when, things seem scary, because it always, like, look at this year as an example. Things have gone down drastically and have come right back up drastically. So,
That's it.
let it
That's
ride.
true.
Stay buckled in.
It's true. If you literally get off the roller coaster, that is detrimental.
Yeah. You're going to lose your money. Okay, beta.
Beta. I'm getting into fun words now. So beta is like your benchmark. Beta measures how volatile your portfolio, a stock, or anything compared to the overall market. So the market has a beta of 1. That's your benchmark. If a stock has a higher beta, like Nvidia does, Tesla definitely does, I think it's a beta 4, it means it moves 4 times more than the market does. It's more volatile, if you will. So something with a lower beta, we talked about this a little bit with dividends, doesn't move as much, and so it smooths out volatility. See how those go hand in hand?
And when you say the market, you're talking about the S&P 500, right?
Correct. Yes. Thank you.
So a beta of 1 means it moves with the S&P 500, basically. And then, anything higher than a beta of 1 is just more volatile. It has the opportunity to go up higher than the market in price or value, but it also has the possibility of going down way below where the market is.
Yes, exactly. And if you've got like 1.2, it's going to move 20% more than the market.
So it's like that higher risk, higher reward kind of mindset, but that means you could also lose a lot of money. So just remember that.
Exactly. That's it.
Okay, alpha.
Alpha is a really fun word. This is the way that your portfolio or a specific security performs better than the market, like better risk-adjusted return. You're adjusting for risk, and your risk is the market in a way. So there's even a popular company called Seeking Alpha. We'll say adding alpha to your portfolio. That means you are getting excess return of an investment relative to the return of a benchmark index. If that makes sense.
It's not about keeping up with the market. It's about beating it.
Yeah. So let's say your overall portfolio returned around 12% in a year, and the S&P 500, which is going to be your benchmark, returned around 9%. You took on the same level of risk, so your alpha is just the difference of those two. So 12 minus 9 is 3.
So you have an alpha of 3%.
So that means your investing decisions added 3% of risk-adjusted value beyond just tracking the market, beyond the market. So it's an active management, and it's used to measure skill, really, if you will.
Do you see alpha? Like, I guess I haven't noticed this because we haven't talked about alpha before. I see beta showing when you're looking at like a stock quote, for example. Is alpha there somewhere, or would it be?
No, it would be. You should be able to pull a lot of financial ratios. We haven't gone to too many detail in those, but yeah, there you can go on your brokerage firm, type in, it's called the security profile, pull up a stock, and then you'll see all of this information.
Oh, okay.
Yeah.
Good to know.
But positive alpha means you beat the market. Negative alpha means you lagged the market. And maybe that's where that alpha term comes from because it's in the name, right? Alpha is alpha, like alpha male, alpha female. You're in charge. You're doing better. Beta is testing, right? Benchmark. See how everything is in its name.
Okay.
Mm-hmm.
So it's not like you just get higher beta securities to have more alpha because, the higher beta could also mean you lose more and then you're in negative alpha or
Yeah,
like
that's
below
that's
alpha.
possible.
Okay.
Yeah, you could have a high beta positive alpha or high beta negative alpha. So if you see a high beta positive alpha, then that means it has higher volatility and is beating its benchmark, which is the S&P 500.
Okay.
Mm-hmm.
How about a growth stock?
So these are companies that are expected to grow faster than average. They usually reinvest their profits. Did a TikTok on this the other day. The difference of a growth stock versus an income stock. So their profits, what are they going to do with that? They're going to take those profits, give you a piece of it in the form of a dividend, or they're going to take those profits, reinvest it back into the company in effort to get more sales, or maybe reduce expenses, expand those profit margins. That's a growth company. Whereas an income, they're just going through their day to day. They're not innovating. Therefore, they're just kind of solid, and those tend to have a lower beta. No alpha because it's a different investment objective. When you
Right.
invest in a growth stock, it's like technology. Income stock, it's like Verizon.
So, yeah, the company is reinvesting its profits back into itself. And that means they're basically planting seeds, but not handing out any fruit yet.
Yeah, exactly.
Growth. They're growing. They're trying to achieve more growth. So then this is what we talked about a few episodes ago. What about a dividend stock?
Oh, I accidentally described that. Whoops.
That's okay.
Well, do it real quick again. If you take a portion of your profits instead of reinvesting it back into the company in order to grow it more, grow the top and the bottom, you're just giving a portion to shareholders. And some companies can be both. They may have less of a dividend, but they can give out a portion of their dividend and still reinvest profits. So, no, like Apple's a good example, even though it hasn't really gone anywhere as of late. But know that they can be both. You just may not be in one bucket. And there's actually this asset style box that you can pull by Morningstar that says growth versus income and see where they fall in that spectrum.
Oh, that's cool.
Yeah.
Okay. Well, yeah, we talked about dividends a lot a couple episodes ago. So go check that one out. How
Mm-hmm.
about we also talked about this in the dividend episode and last week's episode? What about sectors?
So, a sector is a group of companies that operate in the same industry. There are 11 GICS sector, and it's how we categorize things. And a lot of times we'll say the S&P 500 is tech heavy. That's because 30% of it is made up of technology. But how do we know that? We have these 11 GICS sectors that are a classification that's absolutely widely accepted everywhere. And we put every company there. And it makes sense. You would say, I work in technology. Oh, where in technology do you work? I work at Apple. Why do we always use Apple as the example? I have no idea. But or
Everybody knows that one.
I work in Nvidia. I work at Google. Well, Google is not actually a technology stock. It is a communication services because they primarily get their revenue from ads. But the point is, every stock belongs to a sector. It's their little clique, if you will.
Oh, yeah.
Mm-hmm.
We're grouping them into
Mm-hmm.
these little cliques.
Yeah.
And sectors move differently depending on the economy.
Yes, exactly. The
Hmm.
business cycle. Some do better in contracting environments, others in expansion environments. So if we're expanding, that means growth is going to thrive. If we're contracting, things that are more steady will be better.
And how about diversification?
So, building on each other, we don't want to just be concentrated on one sector. we don't want to have all of our eggs in one basket. You need to invest across different sectors and asset classes, not just stocks or equities, to reduce risk. And the purpose of that, we talk about seeking alpha or constructing an entire portfolio. The key to that is diversification. And that traditionally is done when you're first investing in index fund. It's passive, it's mirroring the market. It might be the S&P 500, it might be another index because there's hundreds of them. But an index fund gives you diversification, which just means variety. But true diversification means variety in equities, varieties in sectors, variety in asset classes. So not only equities, you might have some fixed income exposure. And it also means variety geographically, international exposure too. So you've got exposure to different things. So if something goes wrong, something else will help your portfolio. And that moves into the next turn before I go any further.
Basically, so you don't want to put all your eggs in one basket. Like we say, if one basket breaks, then you still have others and you're not, totally in the hole.
Exactly.
Okay, so the next term is asset allocation. How does that work?
So this goes into diversification. You can be diversified, but you need to allocate those assets accordingly. So it's in the name. Our assets are allocated. So I like to think about a little pie chart, or even actually, I think a better analogy is scales. I'm making this one up as I go. It just came in my brain. So if you have a portion in equities or stocks, or even different sectors, that's one scale. And then you have another in fixed income products. And you'll say, I only want a certain amount of weight on this scale, and I want a certain amount of weight on this scale. There's a traditional portfolio, it's called a 60-40, where you have 60% in stocks, 40% in fixed income products.
Okay, so just breaking down into those two groupings.
Yes, that's an asset allocation. That's an example. But effective asset allocation, I'm adding a bonus word. It's called rebalancing, which I think we had one episode on this a while ago.
We had an episode on asset allocation and talked about rebalancing our own portfolios.
Yeah. So if your weight is supposed to be 60% stocks, and generally fixed income product, they work inversely. So if there's a sell-off in stocks, people go to flight to safety into fixed income.
Like
so
bonds, the treasuries.
Yeah, exactly. Yeah. More buyers rises the price. So that means when your stock side starts going really, really high, so we're looking at it in the weight and you've only got a certain amount of weight, that means if you want to keep this 60%, this is too high on your stock side, you need to bring it back down to 60% because your 40%, where the fixed income is, might be at 30%. It gets to 70-30. You want 60-40. That means when your equities get out of 60%, you need to sell it and buy more fixed income. So it forces you to sell high, buy low, but it's effective asset allocation, effective rebalancing. And that's the key to a very disciplined approach. And honestly, that's what the S&P 500 does. It's got a rebalancing mechanism that it does every quarter. It adds new stocks and removes stocks every quarter. And that market weight is determined by market capitalization. There's some methodology behind it. That's why the stock market always goes up, is because it's not the same 500 companies, but it's the 500 companies that are diversified with sector, but has a methodology for its asset allocation, and then it readjusts.
Yeah, because remember, an index or indice is like an elite club, and there is criteria to stay in that club. And if companies no longer meet that criteria, they get kicked out and new ones get added.
Exactly. And that's what you're doing when you start getting into portfolio management, is you're deciding the criteria to be in the club that is your portfolio.
Ah, yeah.
Yeah.
So and I think that's kind of the thing. We talk about long-term investing and we talk about stay invested and stay in. But you do have to remember this asset allocation piece to your portfolio and whatever you decide your asset allocation should be. So in our example, 60% stocks, 40% bonds or treasuries or whatever. Then you got to make sure that your portfolio is staying like that. And usually there's a pie chart in your brokerage firm or something showing you what your asset allocation is. So you can see where you're at. And if you're like, oh no, I'm somehow 80% stocks right now, you need to sell some of those stocks. And I think we could maybe have an episode on like figuring out how to sell the right stocks in your portfolio, because I get
Sure.
nervous selling anything. I just like keep everything in there. And then luckily we learned about tax loss harvesting at the end of last year. So I was able to sell off some stocks that like kind of didn't do well, tanked, to, recoup some benefit of selling off some. I think I actually sold some things when they were high and kind of balanced that out. We talked about tax loss harvesting at the end in December, the very last episode. But I think knowing when to sell,
Being strategic about it.
yeah, like I think I get nervous about selling off certain stocks because I guess like look at Nvidia, it was what, like 92 cents a share in the early 2000s, and now it's way more. So it's like kind of knowing how long to hold on to something for. We talked about like the whole you got to know when to hold them, know when to fold them episode about
Yeah.
selling things off, but I get nervous about it personally, and I'm sure other people do too. And of course, there's tax implications. So we
There
talked
is.
about capital gains earlier in this vocabulary list, being taxed on things, and then knowing like, oh, if you hold a stock for a year and a day, you get taxed less. So like there's a lot of things to kind of consider before selling off anything in your portfolio to keep your asset allocation the way you want it. So that might be good.
That's a great idea.
Yeah.
Let's do that. We should, I mean, maybe we should just make a portfolio.
Yeah. Let's do
We
that.
could,
A market maker portfolio
we could do that.
for educational purposes only.
Yeah, my fear is people will buy everything we put in
Yeah.
it, and finance is personal, and like, don't do that.
Yeah. Well, we can make a fake one.
I mean,
And like fake companies.
That's true. We could do it that way. I've always liked writing finance content where, sorry, tangent, but we could leave it in here. But if I'm explaining Apple, I would use banana, like, I did it on my TikTok. I was talking about Amazon, but I called it rainforest. And
Yeah.
I said instead of Prime Day, they have Optimus Day. We could
That's
go
good.
really far with this.
We could. We could.
And I'm here for shenanigans that are
yeah.
still educational.
Dopamine hit. Yes.
Oh, we have a review to read, by the way.
Yay. Review time. We need a little sound clip right here.
Jingle. It's time for a review. This one is from Lightlings2. Listener of all the episodes, 5 stars. I binge listened to all the episodes when I learned about the podcast a few months ago on your Money Guide on the Side podcast. Totally love that podcast, by the way. Recommend. And have listened ever since. I listen to the episodes when I drive the highway and country roads for work. The content is geared towards beginners like me and has helped me understand enough about investing to feel comfortable doing self-directed investing. Content focuses on understanding the stock market and what is happening in the stock market, a blend which is helpful and puts the knowledge learned into practice. Their weekly report is a wealth of information beyond the podcast. I appreciate the student-teacher format. Jesse asks the questions that are going through my mind. I also appreciate their listener involvement and genuine desire to help the listener. That is so kind. That was a really nice review.
Couldn't have said it better myself.
Well, thank you. If you would like to leave us a review and give me all the feels, please feel free.
Feel free. It's in the name. Just kidding. Okay.
Oh my goodness, it is.
Okay. Well, we've covered the 30 most essential investing terms that every self-directed investor needs to know. We read a lovely review, and we appreciate you for reviewing us. So as always, thank you for listening, subscribing, and sharing. Send us your questions. We love hearing from you.
Until next time, keep learning, keep earning.
And keep breaking those barriers.
Remember, investing involves risk. There is always potential to lose money when investing in securities. Market Maker provides educational content and resources for informational purposes only. We are not registered financial advisors and do not provide personalized investment advice. Any information provided by Market Maker on our website or podcast is not intended to be a substitute for professional financial advice. Market Maker is not liable for any investment decisions made based on our content.